Okay, in this chapter, I want to touch a little bit upon what we're going to look at when we're looking at systems, and this is the pre-work to the systems. Obviously, a lot of people want to have trading systems which are out of the box. Others want to develop their own. Whichever way you go, we need to understand how these are constructed. So as good swing traders, we're able to be profitable. So getting right down to it, first thing is the mental attitude. Essentially, it can be encapsulated in this manner. Don't worry about what the market is going to do. Worry about what you're going to do in response. A lot of people try and anticipate where they think share prices are going. They say, well, you know, if the Chinese demand for commodities is so great, then this is going to happen, or if this happens, then something else should follow, and so forth. And inevitably, they're wrong. The market outsmarts them, or market knows they're thinking that, and therefore does the opposite just to pick up their money pretty cheaply. Instead, we need to worry about what we're going to do in response as the market moves, and all good systems encapsulate what we should do if the price moves in the direction we want it to move and in the direction we don't want it to move. And you'll see that through some of the test systems that I include in these CDs. But this frame of mind, this attitude, which doesn't come across from many private investors, that's essential as a background. Now, the key to money management as part of systems trading is the following. Select with great care, including price confirmation. When you are picking which stocks to enter into, wait. Don't get greedy thinking, here's a market, I must be able to trade it no matter what it is. Instead, be patient and wait for the right ones to pounce on. Include price confirmation. Whatever your system tells you, wait for the price to do what your system says it should do. The patience, again, comes into it as it did up here. It's better to have fewer trades than have trades at losses. And again, that's an attitudinal thing. Many private investors do the same. They'd rather have more trades in the hope of getting lucky and have a lot of losing trades as a consequence. Secondly, before you get into a stock, you're probably looking for something which is going to give you an expected return of about 30%. Now, that might be with leverage. So it might be that the underlying stock moves up, say, 10%, but because you're trading spread betting or CFDs or whatever else it might be, overall, you go up 30%. However, once you've decided to make that trade, once you've made that decision, you've got to ignore this 30% target. The market will tell you what it's going to do, and it's entirely up to the market. You can't impose your view on the market. Better to have some return, even if it's, say, 10% in the end, than to have none because you were waiting for that 30% rise, which might be all the way up here, and the market just didn't get to it, fell off, and you ended up with no return or a loss instead. So, it's better, once we've evaluated where we want it to go, just to let the market take us where it wants to go. And if you're wrong, get out. Set a point at which you know you will be wrong. Even if you might be right in the long run, plan for the retreat. Decide when you will know you're wrong and calculate what. And it might be a 20% loss, it might be a 10% loss. What that price is at which you need to get out. Now, if you're looking at a 30% gain, then obviously you can't be willing to hold on to a 30, 40 or 50% loss. You've got to hold on to a relatively small loss because your reward has to be greater than your risk. So as we'll see as we go on with some of the charting, we need to mark out points on those charts where we know we are wrong and we have to get out. And all good systems have to encapsulate that as well. When we're bearish, there's nothing wrong with going 100% into cash. If we just don't know what's going to happen, it's far better to do that than to hold on relentlessly. Okay, moving forward, similar kind of issues. Risk management is about discipline and cutting losses. I keep on saying this. Pat Arbor put it in those terms. He was the chairman of the world's largest derivatives exchange. John Najarian put it in this way: remain in your comfort zone. Now that's in trading. In trading, you have to be comfortable with the size of your bets. Unfortunately, what many people do in trading is they start taking ever larger bets, so they're uncomfortable, and then you get asked questions like, Oh, what do you think's going to happen? Should I ease off? I've got quite a large loss or quite a large gain. If you need to ask that question, then you're not in the comfort zone and you've got a problem. You're betting too large a trading size. Stick to the game plan. What makes this trade make sense? How are the odds stacked in my favor? How will I know it's not worked out? And what will the loss be at that point? These are absolutely vital questions that are implicitly answered by professional traders. They're just answered through know-how. They're done in the mind. If it helps you, write these out. Have them in front of you on your trading desk. Have them stuck on the wall above your computer monitor so that you remember always to ask them. George Soros put it this way: the key to long-term gains is the preservation of capital. That's why there's been so much focus during the swing trading CD-ROMs on the loss side, on the downside. And what's extraordinary is the number of times Soros is wrong. He's wrong so many times, and he'll admit it, because he knows he has to admit it freely in order to preserve capital. If he closes positions, he'll close them whenever he has to close them. And he'll honestly say to himself, I was wrong on this. What's important is not whether you're right or wrong, but how much you make when you're right and how much you lose when you're wrong. If you make a mistake, you have to respond immediately. And you could think that somebody like Soros would be so arrogant and such an egomaniac, he would never accept he's wrong. But in trading, he will say that. If you read his book, he will tell you, I was wrong on oil or on Forex or whatever, and he'll get out and he'll do a new position. And that's the way it is, and that's what a good trader should always be willing to do, and quite often don't do.